if we go back 40 years, right, we see real estate and agriculture assets held, private equity in institutional portfolios, right? We see insurance company reserve funds. We see state pension funds. We see alts living primarily in that institutional space. But as technology has scaled and we've been able to see that trickle to the family office space and the RIA space, I know you're an absolute expert in that connection tangent world. I was wondering if you could share with me your perspective on as alts have gotten more plentiful in the RIA market and kind of how you've seen that journey happen.
Yeah, so plentiful in the RIA market in terms of ability to access.
Yes.
I would suggest that actual usage is low.
I would too.
So 70% of financial advisors don't use alts.
Right.
And the average allocation an advisor does have to alternatives, if they use them at all, is somewhere between 5 and 7%. And I've seen upwards of 9. I think that's aggressive. I am inclined to think it's closer to 5. It was 3, like 5 years ago. In general, institutions allocate somewhere between 20 and 35%. And for the ones that don't need liquidity, so endowments specifically, it can be upwards of 80%. And I think that one of the interesting evolutions here is accessibility helps. But it's still been limited because most alternative products have regulatory restrictions on who can invest in them, and you have to meet those hurdles. There are things like qualified purchaser rule, which requires that you have 5 million in liquid net worth. I think that's what it is. And then the accredited investor rule, which is nuanced. It's 2 million in net worth. It doesn't necessarily have to be liquid, or your income exceeded a certain threshold over a period of time. And so traditionally, these structures, because they are private vehicles, they're considered sophisticated.
Sure.
And it's kind of like buyer beware, if you will. The regulators don't want to get too involved. They require these hurdles to ensure that only quote unquote sophisticated investors can invest. So until say 2007, it really was just a space for really ultra high net worth individuals, even if it was an individual. In 2007, the SEC made changes to the Investment Company Act of 1940, which is the act that covers the formation of things like ETFs, mutual funds, closed-end funds, and the like. Registered product that's available to any investor. Though that rule change allowed for mutual funds specifically to use leverage and to short a portion of the net asset value of the fund that was not allowed prior. So at that time, anybody who was around then will recall there was a massive amount of 130-30 and 120-20 and 125-25 funds that came into the market. And so those funds are reflective of the change in the rules. So the max you could short the NAV of a fund was like 30%, which is why everything stopped at 130-30. But those funds aren't really alts. I mean, they're still beta 1, and they're basically shorting as a form of leverage to get more long exposure.
Sure.
And most of them were not great. And I challenge you to go find any existing 130-30 or 120-20 funds. There's maybe 3 or 4 that still exist.
Okay.
But there used to be hundreds. So that opened up the floodgates to bringing alternative products to the market, but mostly things that hedge funds had traditionally done. Long short equity, global macro, managed futures.
Sure.
Big firms like AQR in particular kind of launched a lot of mutual funds at that time that fall into that space. Abbey Capital is another one. There's a number of really big firms that you've heard of that have a nice amount of product in the space. And those firms actually were, in the case of AQR, in the case of Abbey Capital, like hedge funds prior. So they were just bringing products they had already been managing for years and years into a different structure. Then in 2019, The SEC made changes to ETF rules that allowed for active, non-transparent ETFs. And in doing that, that allowed for these same products to now be offered in the structure of an ETF. So that reduced the fees associated with them, made them even more liquid and accessible and easy to trade. So we've seen less mutual funds and a lot more ETFs come to market in the space. And then the final real domino to fall that has really opened accessibility to the average investor is the advent of the interval fund. So the interval fund is a registered product under the 1940 Act, but it is not like a mutual fund or an ETF. It is not daily liquid, but it allows for, because of its structure and it not requiring daily liquidity, it allows for investments in things that are non-liquid, like private equity and private credit and venture capital. There's about a little over 200 interval funds now in existence, and the vast majority are real estate. So 70%. But right now, the trend is that every VC fund on earth is trying to launch a interval fund.